Hey guys, how's it going and thanks for coming. I'm Nick and this is Real Life Money, where we talk about real life and money. Please do not forget to subscribe. So this week I was going over retirement accounts. My last video was going over 401ks versus Roth 401ks. If you guys are interested, I'll leave a link in the description. But once you decide what to set your 401k up for, like your retirement account, then you have to pick the funds inside your retirement account. Now, something very popular now are target date funds. And in this video, we're going over what they even are and are they worth it for you? Well, I could tell you what they are not. Now, they have like different years. It could be like 2020, 2030, 2040, whatever. So that's when you are supposedly supposed to retire. That does not mean you are going to retire at that year. As in, like, if you invest in this fund, that means you're going to retire in 2020? No, that's not how it's going to work. All that it is that everyone has a different percentage of stocks and bonds. Let's say you could have like 50% stocks, 50% bonds. So if you don't know like how to set it up, if you want more stocks, if you want more bonds, this target date fund does that for you. So if you have longer until retirement, so if you're retiring in like 2060, you're going to have more stocks in that fund versus something in like 2025, in like a few years, it's going to have more bonds. If you're unaware, the reason behind this, because stocks have more growth, but they're also more risky, especially in the short term. So if you're going to retire rather soon, you want to conserve your wealth. You might want some income, you want to be more conservative and less risk, so you would want more bonds. So what the target date fund then does, for example, for me, if I pick, I don't know, 2060, let's say, I'm going to have more stocks. And as I get older, they are going to change it into more bonds as I get closer to retirement. That's what a target date fund is. So that's probably a lot more simple than you might have imagined. But are they even worth it? Well, there's a huge assumption that target date funds use. They assume that stocks are risky and bonds are safe, and they are not correlated whatsoever, meaning like if stocks go down, bonds stay the same or go up even. Well, that's simply not true. If you looked in 2008, both stocks and bonds both went down. Now, this was like a big thing. This was the Great Recession. But they were highly correlated. I was reading Tony Robbins' book, actually. He goes into that. I'll leave links in the description if you're interested in that book. But he goes into so many different things. And this was one of them. They were actually correlated 80%. So just a quick example, in 2008, if you had a target date fund of 2010, meaning you're retiring in a couple years, you would think it would be like ultra conservative and you wouldn't plan on losing a bunch of money. Yeah, well, these target date funds actually dropped, not as far as the market because it still had a bunch of bonds, but because bonds were correlated with stocks, the average target date fund for 2010 was actually down 20%. Now imagine like retiring in a couple years, you're like all set, you have a good amount saved, and then your stuff drops 20%. That makes your heart skip a beat. You're gonna have to like rearrange your plans. And this exact reason is why target date funds could be seen as a little bit flawed. Unfortunately, they're actually very popular because, like all of us, we don't know what's going on in our 401ks. A lot of us don't even know what our 401k is. We don't know what to invest in. So it's easier to, hey, I'm going to retire in that year. I'll pick it. That's why people do it. Very popular. It says like around 40% of people are actually invested in these target date funds. Side note, if you sign up for a 401k and you don't like choose your own investments, your company sometimes just automatically enrolls you into these target date funds. So you don't necessarily pick them, but you're investing in them, which could also be a main reason why they're so popular. Now again, it really depends on so many different things. Now before these target date funds, Some people, still like today, have no idea how to invest for retirement. For example, you would have 100% of your retirement account in, let's say, your company stock. Well, what happens if your company stock plummets? This happened with Lehman Brothers. If you don't know about Lehman Brothers, they went bankrupt. Their stock went to zero. So if your entire retirement account was with them, you're left with nothing. That would suck. Other people would, let's say, pick just one fund. Well, what happens if that one fund drops? Then again, your entire retirement account drops. So in these instances, yes, a target date fund would make more sense because you have a little bit more diversification between stocks and bonds. However, if you want to be a little bit more intelligent with your retirement, there are better options. The main reason why there are better options is because there are a lot of fees involved with so many different funds. There are fees involved with 401ks, which you might have not even realized. Yes, there are fees and expenses in your 401k that you probably don't even realize that exist. I'm looking into mine and I'm realizing there are so many hidden things that you're paying for. So watch out for that. But at the same time, because these target date funds, someone is doing that for you. Do you think they're going to do that for free? No, absolutely not. So you are paying for those people to do that for you. You're paying more in fees, more in expenses to have people determine how much stocks you should have, how much bonds you should have, and as you age, they change those percentages. And it's amazing because sometimes they're wrong. Now, I don't want to get too deep into this of like how much stocks you should have, how much bonds you should have. You could do 50-50 to keep it simple. Of course, it depends on how old you are or how close to retirement you are. One rule of thumb that's very popular, and I'm not saying that it's ideal for everyone, but it's just to get your mindset kind of structured of how to do it. You take 100 minus your age, and that amount should be how much stocks you should have. So for example, I'm 25. Well, I'm 26, but to keep it simple, 25. So let's say 100 minus my age of 25, so I should have 75% of my retirement account in stocks. Of course, this is going to take a lot more research for you guys, unfortunately, but like this is really important. It's for your future, it's for retirement, it's for your family, it's for your, generations, for kids and all that stuff. So definitely look into it if you guys are interested. Leave comments down below if you have questions. I would love to answer those or even make more videos. But the main idea is just diversify. Don't have all in stocks. Don't have all in bonds. Don't have all in cash. Have a bunch of everything. Also understand that when interest rates increase, bonds decrease. That's how bonds work. So right now we're actually at very low interest rates. So over time, bond values are probably going to decrease. So watch out for that. So that's the basics of target date funds, guys. Again, if you have any questions, comments, concerns, please leave them down below. I'd love to hear what you guys have to say. Do you invest in target date funds? Do you even know what you invest into your retirement account? Let me know. So thank you so much for watching, guys, and I'll see you in the next one.